Hello and welcome to eOption's webinar. And we're excited to have you here and thank you for taking the time out of your day to join us. We're happy to partner with Teddy Keckstad, again, a professional trader with over 30 years of experience, to bring you this webinar on 10 ETFs every option trader should know. Some of you may be familiar with Teddy. He gave our last webinar about a month ago, and so we're excited to have him back. My name is Gina Bocayas, and I'm with eOption. And just to provide you with some logistical information on how this is going to work today, the webinar session will last approximately 1 hour. And if you have any questions during the webinar presentation, please feel free to type them into the question box at the bottom of your screen, and our speaker will answer those at the end of his presentation. You should see a little box at the bottom that says Q&A, and you can enter your questions, just type them in there. Also, you can reach eOption's trade desk at any time if you have any additional questions after the webinar. And if you go to eoption.com, you'll also find information on option strategies where you can type in the strategy or click on it and it'll show you basic information, as well as you can see our other educational videos and other webinars we've done in the past. And so for those of you just joining, we'd like to welcome you to our webinar on 10 ETFs every option trader should know. And I'd like to turn our attention to our speaker now, Teddy Keckstad. Teddy has over 30 years of experience in the financial industry, and he has years of trading and industry experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. And he's been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked Incorporated, and he also has a YouTube channel at Forex Trading Unlocked that you can also check out. He's the author of a book called High Probable Japanese Candlestick Patterns, and he has a degree in finance from DePaul University in Chicago. So without further ado, I'll turn it over to Teddy Keckstad, and we'll get started. Thank you.
Thank you, Gina, and thank you to the viewers for showing up for our webinar today, 10 ETFs every option trader should know. And I want to thank you very much for that great introduction. So since she gave the background for you guys, we can just skip past this slide right now. And real quickly want to give you the eOptions disclaimer to remind you that this webinar is for educational and informational purposes only. And since every time I do something, I also have my disclaimer for my company as well, Forex Trading Unlocked. So let's get to what you guys are all here for today. First of all, you're going to learn how to maximize your option trading potential with ETFs and ETF options. So now how do you do that? Well, you use eOption for your ETF and ETF option trading right off the bat. There's a good start. One of the reasons why is you get free option strategy trading tools like Options Play that are available on their website. You have a free option strategy guidebook, which is available at eoption.com as well. So the strategy that we go over today and the ETFs that we go and the examples that go over today, you can actually run your own kind of examples and strategies through these things as well. You can sign up for a free paper trading account to test your strategies like the ones that we're going to go over today, and you can see how these might work in the future on different ETFs that you may particularly desire on trading. And also there's another reason to go with eOption, because ETF and stock trades are commission free, and also their option contract commissions are only 10 cents per contract. So they are right there with all of the majors, and unlike some of the newer ones that you might think, oh, it's a cheaper and better deal, well, you get what you pay for, and you want to have someone you can talk to, and you don't want a brokerage house that's going to go down either. So let's go into what you're going to learn on how to use these tools from eOption. Well, you're going to learn how to expand your opportunities in broader market sectors for one. We're going to cover 10 ETFs today. And I think that you're going to really like how a couple of them we really bring in how you can really see how you can integrate ETFs and ETF options in a way that will give you a chance to participate in broad markets without having the risk of where you would if you use other different derivatives and things. So your expanded portfolio diversification is something also that you gain by using ETFs and ETF options. So instead of just having outright stocks or bonds or funds, you can actually, like I said, participate in different ETF sectors, and we'll cover them as we go along. So now here's another thing we're going to talk about is how to maximize your potential return returns with options on ETFs. Okay, and then we're going to also use simple option trading strategies that can increase your odds of success and protect your trades. So this is what we're going to get into. I think it's something that you're going to find that's valuable, whether you're a new trader or new to options, or if you're an experienced veteran trader like myself. So bear, bull, or neutral outlook strategies. Well, there's all kinds of strategies, and we're going to show how the strategy that we're going to use is kind of like a little bit of all three put together. So how eOption can help improve your bottom line? Well, like we said through the last slide, as far as being commission free and very cost effective on option trading, now we're going to show you how to use their products and their platform to implement these trades. Okay, here we go. So why ETFs and ETF options? Well, first of all, you lower your cost basis. ETFs are commission free, and at eOption, it is only 10 cents per contract, much lower than other firms. Now, here's the thing you got to think about. Let's say that you want to participate in broad market sectors, and we're going to get into some some examples of where there's metals markets, interest rate markets, equity markets. If you want to trade derivatives like the S&P 500 index and the futures and futures options, you have to be, one, a very skilled trader, have a very good amount of capital behind you, and understand the risks. But with this, using ETFs and ETF options, you can do the same thing without taking on all the risk, let alone having all the margin issues as well. So ETFs help you diversify your portfolio because you can trade broad market sectors through one product and without the high risk of leveraged derivatives, like I was saying. So ETFs allow smaller to larger investors the ability to capitalize on trending markets that are highly liquid. So for instance, like the S&P has been all over the place because of the coronavirus fundamental trade that was on for a few months. And then also we've had recently, because of other geopolitical things, especially political things within the United States, that have caused a lot of instability and volatility. How do you capitalize on these things? Well, let me tell you, as an ex-S&P guy from the floor, you don't want to be trading the S&P futures or futures options unless you really know what you're doing. I like it, but I would suggest most people stay away and look at the spiders, and the QQQs, which we're going to get into. So in both the ETF and option pricing, the spread is typically very tight. This is another thing where you gain an edge. If you're trading the futures or those leveraged products, typically the spreads are not always as good as you would get in the ETF market. ETFs are very, very liquid. They're just like your heavily traded blue chip and other heavily traded Nasdaq stocks and Russell stocks and things like that. They fall into a classification where even on a slow day, you have liquidity, which means your bid offer spread is very, very tight. And a lot of times you're basically getting in at the market, like at the actual price point. There's not much of anything. You're right at the actual cash price, which is very significant when it comes to your cost basis for trading. When you think about the spread getting in and out of your trade, the wider that is, that means that you're giving up, and the more edge you give up getting in and out of your trade, that goes against your bottom line. So your winners are less and your losses are greater. So using ETFs and ETF options helps to control one variable that is something that definitely will be indicative of whether or not your bottom line is higher or lower. Not necessarily that your trading is going to be higher or lower, but at least that one variable will be. Trading in these products is the same as trading in any normal equities. So for any of you that are used to just trading like IBM or Apple or, Tesla or whatever stock you're talking about, and even starting to trade those options, ETFs are no different. It's kind of funny, like when you're new to trading, you start to hear about this market and that market, you're like, oh, what does it mean? What does it matter? Like someone like me who's been trading for 30 years, I buy and sell numbers. So it doesn't matter if it's a futures contract and a stock price, stock market product, or an ETF or an option or whatever you want to call it. I just buy and sell numbers. But for now, you need to focus on what we're talking about, which is the ETF options markets. So trading these products is the same as trading in normal equities. Okay, so now 2 for the price of 1, the collar. This is the strategy that we're going to be using for this webinar. You own the ETF, okay? So we're going to go over 10 of the that are the top 20 ETFs that are traded. So these are all, like I said, highly liquid ETFs where you're going to have really, really good actionable trading results because of liquidity. So in this trade, you're going to buy a put at a strike price A, which is below the ETF price. And then you're going to also simultaneously sell a call at a strike price B above the ETF price. Now, this is because you are bullish to ETF, but you're starting to get a little bit nervous about the trend, especially over anyone that hasn't been in a coma for the last 4 months knows that 2020 is something where everyone's been nervous about every trend, no matter what market you're trading. But this is good for traders because we want opportunity. The only way you can have opportunity is if you have market movement and market volatility, which those are two things that we are not lacking right now. Time decay is neutral for the most part. The reason for this is, and we're not going to get too heavily into the Greeks because, which are the different valuations on how you price out an option. But this strategy kind of is nice. Remember how when we started out, what are we going to learn today? How is this going to be a bullish, a bearish, and a neutral strategy? Well, the neutral part is that time is neutral for the most part. You're going to be buying one option and then you're selling one option. So where it fails, where time starts to decay on the option you bought and you're losing value, it's helping you in the option that you sold because it's losing value because of time decay as well. And then that also means you're being a plus side on that. Now, implied volatility is also fairly neutral because it does the same thing. So if implied volatility drops, meaning that whatever the ETF price was and options pricing was when you got into the trade, if volatility goes down, the value of both those options are going to go down, but that neutralizes itself because the one you sold, you want that to happen. Obviously, the one you buy, not so, but they cancel each other out. So those are two things that you don't even have to worry about. Now, that's a very nice thing when you're putting on a trade. Now, the one thing we are going to have to look at for this trade is the options will be traded anywhere from 30 to 45 days out. This gives you pretty much the best pricing mechanism besides the fact that, remember, I mentioned about the spread. So getting into the spread for not just the ETFs, but the options, you'll get the best pricing, the best liquidity. And also, like, since time and implied volatility don't matter, the beginning part of the curve or the later part of the curve, these are all things that you would talk about if you're studying the Greeks on how to price out a trade. We don't have to worry about that. So we're making it very simple. So for all those of you who are wondering, is this a complicated trade? Absolutely not. Now, the funny thing is, it's actually two trades. When you sell a call, that's like you're doing a covered call position when you have a stock, okay? And if you're buying the put, well, that's when that's the same thing as when you're covering a stock, as if you wanted to see if it's going to go down, and you want to hold the stock indefinitely or for a long period of time, but you're nervous about its short-term potential trend position, as far as whether you're going to continue to go higher or whether it's going to start to reverse gears and all of a sudden become a bear, and you don't want to give up your potential gains that you've already seen on your position. So now now that we've explained everything, let's get into the first trade. So here we have the SPY. So what is the SPY? Well, this SPY Spider is the S&P 500 ETF Trust. So this is basically, when you talk about the S&P 500, this is what it is, except this is the ETF that goes on it. Now remember, there's the S&P 500 index, there's the that's the cash, okay? Then you have the futures and the futures options. Now this is the Spider is the for the SPY, is the ETF equivalent of the S&P 500. So when you hear the S&P 500 number on the radio or the news, and when they talk about the financial shows and the markets, the Spider would be something that is basically the same thing as the S&P 500. Okay, so with this trade, here we are on June 8th when I made this video for this webinar. I looked at the pricing, and I figured, okay, we're going to take these 10 ETFs and how we're going to place these trades. So what are we going to look at? So here we have the market has been railing up into June 8th. As we know that while there's been all kinds of crazy volatility between the coronavirus fundamental and everything else, the stock market somehow bounced at the end of March and has continued to leg up higher, even though it has not made all new highs yet. So with this trade here, the market was trading at 321.19. So this is where the top is right here. And as you can see, this yellow line, this is the upward sloping support line that is maintaining the trend, okay? So we have the SPY 325 call that costs $498. Okay, and then we have the SPY 315 put that costs 781. So our collar trade is we sell the 325 call at 498 and we buy the 315 put at 781. And the reason is because we are long this spider. We like the fact that we want to be long this, but we're getting kind of a little bit nervous about whether or not it's going to maintain this rally and stay bullish. Is it time for a correction? Well, corrections can happen at any time for one, but we have a lot of instability and reasons why, for instance, especially with the second potential wave for coronavirus and things like that that are going on. At least this, when this was made a week ago. So this spread, if you put it on, would cost you $2.83. So it's basically, it's $283 because remember, it's a $100 multiple, just like with a regular option trade, whether it was for Apple or Tesla, it's a multiple of 100. So this would cost you $283 to protect this ETF position if you were long the ETF. Now, what does this mean? Why would you do this? Well, this, like I said, you are bullish, but you're wondering that you're looking for a correction. Now, what happens if the market does keep on rallying? Well, if the market rallies and because you sold the call, it gets exercised, well, you're making money on the ETF. So the only thing you lose technically would be your debit of 283. So we just have to look at it. If the market, as long as it gets above $325, which is your strike price of the call, plus your debit of 283, then you've locked in your return, and you already know that the only thing that you did was it did not make $283 out of the max of the move if the market should rally higher. Now, should the market go lower, here's what happens, okay? So our maximum potential profit equals the call strike price minus the ETF price minus the net debit. So that was, like I said, the 325. You got to add 283 to that because that's what you paid. That's what you forego. Okay, so that's where you get your loss in would be just that, or excuse me, you would restrict your potential gains by that 283, but you lock in where you're at. Okay, so you wouldn't be losing money on this. You're just capping your gains. Now, if your maximum potential win, it's totally different, okay? Because remember, you're selling the call and you're buying the put. So if the market was to fall below the 315 price here, that would mean that the call that you sold would be obviously a winner. Then the put that you bought would all of a sudden become a winner as well. Now you would be simultaneously losing money in the ETF. Now remember that this is a strategy where you want to stay long the ETF. What you're trying to do is lock in either a potential return or limit your potential losses in the short run while the market is correcting, not necessarily completely reversing trend. You never know whether a market's going to, which way it's really going. But for instance, in this situation, you're looking to cover yourself. Remember, this is two strategies in one. It's a covered call, just like you have a protective put going on. That's why it's called a collar. You got basically both sides covered on this trade. So our break-even price equals the current ETF price minus the debit paid, meaning that if the market stays where it's at by expiration and doesn't move at all, then whatever gains you're up in the ETF would be minus this debit here. That would be what you would be down in that instance. However, you would have been protected. Obviously, this market would have to go sideways for that to happen. However, you would have been still protected for the 45 days. Now, since I've given you this example, you're like, oh, this is all fine and dandy. Well, what does that really mean today? How does this translate? So we're going to give you the answer to that question right now. So the same example here, we have the spider, but we had this updated to today before this webinar came on this morning. I wanted to see what would be the pricing and how this trade would have evolved for you. And you can see why you put these trades on because of the scenarios like we said. Remember, you are long these ETFs because you like these markets, okay? So being long them, if you didn't hit a target that you want to execute your target price and get out, since you want to maintain your long position, you need to hedge yourself, at least when you know that there's most likely an increasing chance of a market move, whether it's either going to accelerate your trend, which will be in your favor, which is good for you. You can't lose that way. But if it does reverse gears, you want to at least keep some of the profits that you have realized and then for either reevaluate and get out later, or you can put on another option strategy and readjust then. So this particular example here, remember we had the Spider 325 call was at $4, meaning 400. And then we have the, the Spider 325 call is now at $4, meaning 400. And the Spider 315 put is now at 1129. So that's 1,129. Big difference in price, okay? So remember, our original collar trade here was we sold the 325 call at $498. So it's basically just under $500. Then you buy the $315 strike price put for $7.81 or $781. The net debit, remember, was $2.93. Okay, well, here's what happens. Today's open, the collar trade, the 325 call was priced at $4, okay? Remember how I said that? And at $11.29 was the put price. So that means the value, if you were to execute this, would be $7.29. Well, if you sold it out and all of a sudden you have a realized profit of $7.29, that's because then you take out your debit of $293. That means you're basically have a $4.36 profit on this position. So your original ETF price was at $320.79 when I made this video or the slides for this video. And this morning, the market was at $313.45. So as you can see this gray line here, this is June 9th, June 8th. This was when the first example was first made. The market has traded for the past week. And as you can see, remember that upward sloping support line? The market came through it. Now the market made a higher move low. So the market has been making higher move highs, higher move lows, and continuously, which is indicative of a bull market. However, we did take out this upward sloping support line from the main trend. This is the first bearish indication right here, meaning that you're set up not necessarily for a bearish slide, but for a neutral trade more likely than positive trade, okay? And now here's the other thing that's interesting. We rallied over the past few sessions, and now here we're back just above this upward sloping line, but we're below our put price. So now we'll have to see, we still have, because it's only June 6th, 17th, these options expire on July 17th. They're still a whole month away. So if you liked this hedge before, you probably still like it now, because even though you're down on your ETF price, you're up on your options hedge. So you're doing exactly what you want, and you're still long the S&P 500, which ultimately is your goal. Now, should you decide to get out of the ETF and not put down a different options play or whatever, this is all stuff that it would obviously be your decisions for your reasonings and for whatever your goals and trading objectives are. But for this example, we're taking the assumption that you want to be long the S&P 500 indefinitely through the ETF, and you're trying to figure out how to weather the corrections without getting out. Instead of trying to time the market, you know how a lot of people you hear on the major news financial shows, they say average person should not try to time the market. It's going to burn you every time. Well, this is a way of not timing the market by staying long the stock market, but then capitalizing off of short-term corrections. In this case, you would be making, 400 over the course of the past week by holding the ETF and having put on this position, which would have cost you under $300, you would now be up over $400 on this hedge. So for the correction, you would be up that. Obviously, you would be down the difference on the ETF price, but you don't care about that because you want to stay long. You're just trying to limit your losses. And then remember, if the market is going to go back and makes new highs, then your ETF price goes higher, and then you also will be sorry about that, will also be up on that position as well. So whether you put another one on later at the end of the month, at the end of July 17th, is a whole nother topic of a conversation, and we can answer that question later if anybody wants to know that, because now it's time to move on to the next ETF. So now we're going to the QQQs. This is the Nasdaq, guys. This is one which is the high flyer with the tech stocks. If you want to participate in this market, like I said, instead of dealing with the futures, I would definitely look at these ETFs. So now this example, we have the QQQ 245 call, which costs $4.43. and the Q235 put, which costs $652. Remember, for a collar trade, we are selling the call, so we would sell the 245 call for the price at 443 in this example, and buy the 325 put at 652 for a net debit of 2.209. So it'd be just over $200. Now, in this example, the market is trending higher, making higher move highs and higher move lows. Remember, your potential loss, once again, is your debit paid. It's your ETF price minus your debit paid. So if the market goes nowhere, the only loss you have is on the spread. You wouldn't have it on the ETF. If the ETF goes lower, obviously you would be making money on the spread. So in this case, you have the 245 strike price and the 235 strike price for your options, and the market is right in between these two. And remember, the maximum potential profit is if the ETF rallies above the call price, because then eventually you'd be exercised on your call, and you would lose your the difference you would lose would be the debit minus the ETF price once you're exercised out. So you still would be making money. You'd just be making a little bit less money than if you had not put on the collar trade and there is a big rally. However, if there's a break, then it's a totally different story. And remember, your break-even price would be if your current ETF price minus your debit paid. So that's where you're at with that. So you know your maximum risk on your hedge is $209, but you have a potential, remember, if the correction does come, to realize a nice little gain. So let's go to our next ETF, which is the GDX VanEck Vectors Gold Miners ETF. Now, this is a pretty interesting trade to look at here. When we made this slide, we looked at the calls and the puts, and I'm thinking, okay, well, you know that the call has to be above the market, the put has to be below the market. So ironically, the low from the prior session was right above this $31 put. So I used that as the base. So the put was $1.65 in price, and the GDX call was $1.35. Now this is pretty interesting because the collar trade here, you sell the $34 call at $1.35, you buy the $31 put at $1.65, for a net debit of 30 cents. So we have a 30 cents debit. Can I put on mobile with a single click? I'll look at that question in a minute. So anyhow, this would be a net debit. It's next to nothing. It costs $30 to put on this hedge, which is kind of crazy when you think about it. But think about this. Gold is something that fluctuates in a big way. Now, when I was looking at it, I noticed, oh my gosh, while I'm looking at putting on a collar for the GDX ETF, look at what else is going on here. We have a head and shoulders pattern here. So for any one of you that is familiar with technical analysis, you can see how we have this initial bullish trend here with this upward sloping support line, this big yellow line, okay? And that's where the shoulder came up here, and we fell through this, which showed that the market wanted to go kind of neutral. And that's neutral to higher, neutral, and that's what a head and shoulders is. It's where the market starts to lose the velocity that it originally had, and even though it still is pressing through resistance and going a little higher, it's having trouble. So it looks like it's trying to consolidate and base, but it's still bullish. But then you're looking for the turn. So as you can see, here we have this head, and then we had this little break, and then we had this little shoulder. And I notice here's this little neckline. So here's the day I'm looking at the trade, and I'm like, we already have a head and shoulders that's already formed. So this is the perfect time for a trade like this. So just in case you want to know, as far as where the market goes, this actually had gone flat. So basically, the market right now, the gold market, is basically trading sideways over the past week. So not much has happened. So this spread cost almost nothing to put on. You still have a month to go, and the market is basically right there. So in a position like this, you're still long your ETF. You have a month to go, where if there is an upside breakout, and think about this, the reason I'm explaining this to you is that this is a head and shoulders pattern. So this line that's coming across here right around $32.59, this long blue line, which is right where the market was trading at when this example was made. Anything below here, below this put, that's all profit. So you'd be losing on your ETF, but you're definitely getting a short-term correction, but you're prepared for it because you have a head and shoulders pattern. And usually when you have a head and shoulders pattern, it results in pressuring support to some degree. Now, will it get the total maximum target? We're not even going to get into that. That's a whole nother lesson in itself, but this does have you in a bearish way. So remember, you like the ETF. Here's a situation where you have a head and shoulders pattern on. What a great time to put on a collar. So if you didn't like to put a collar on before for those other two examples, here's a reason where you're like, oh, you know what? Now I remember when Teddy showed an example of how the market was railing, all of a sudden there's a head and shoulders pattern. What kind of a trade do I put on? Well, with this one, you don't have to get too complicated. You're pretty much looking for a bearish correction. You put on the collar, you're covered on both sides, and then if you get the break, you actually still get all the bang for your buck. You're still long your ETF, you make money on the hedge, and then you wait for the bounce, and then you're still long your ETF, and you figure out what you want to put on another options play or a different options play at that point. So that's why you use the collar. Remember, once again, the maximum potential loss and the maximum potential profit are the same. So now we're going to go to the EFA. So the EFA is the Russell 2000 ETF. So we've covered the QQQs, which is the Nasdaq. We've covered the spiders, which is the S&P 500, and now we're at the Russell, your middle of the road option, stock index, which covers a very broad base of stocks. So now for the EFA, we have the $66 call and the $62 put. So that means for the collar trade, you sell the $66 call and you buy the $62 put. This would be another instance where the market is slowly grinding higher. You're right in the middle of these two option spreads or these two option strike prices right here. And if the market does start to run out of gas, you know that you are protected and you know that you have the potential to still be long in this upward trending bull market. I mean, look at how we have this upward sloping yellow line right here. Here's the day that we put on the trade on June 8th. It goes all the way to July 17th. So there's still another month going on yet. Anytime that it falls below $62 and then starts to come north, if it does come down towards this upward sloping trend line like it did over here, if it holds and goes back up, well, that's an ideal scenario for you on your ETF, because that means you've gotten a little correction, a little digestion, and a chance at another bullish move higher. At the same token, if you have this trade on, if you put it on this date, as the market comes down to this point, you have the ability to capitalize on that hedge and take a profit on those options and then stay long your ETF. So how you manage it and stuff like that, and the timing, that all is indicative of other factors in your goals and whether you have target objectives and what your strategy is for being long the ETFs. But in this scenario, this is what you would do. Okay, now we're going to go to the HYG. Okay, HYG iShares Box High Yield Corporate Bond. Now this is something where now we're going to talk about the interest rate market. I started out trading sugar and the 30-year bond when I was a lot younger. It was the first two markets that I traded in the futures markets. And the interest rate markets I love because they're very tight. Typically, well, they used to be, especially some of your shorter term rates. Now, when you look at this, you're talking about corporate bonds. Now, we hear a lot about the Federal Reserve all the time. Once they have the FOMC meetings periodically, and you're always hanging on the decision on whether they're going to touch interest rates. Now, recently, we know with what's going on in the current market conditions with the coronavirus fundamentals that have been going on and stuff like that, you can see that this corporate bond ETF has been rallying since the middle of March. Now, one of the reasons this has probably been is because interest rates were cut and the Fed has started to do its open market buying operations, propping up the federal bond market. Now, then there's the corporate bond market. So the Fed came out last week and said, hey, we're going to prop up. The irony of it all is I made this slide, and a couple of days later, the Fed comes out and says that they're going to start buying the corporate bond market. So that's good for those that are holding this ETF. If you were insecure about holding the ETF and you didn't know what option strategy to put on, you got some good news there. But it's on so many levels, I think it's actually more of a problem than good news. In the short run, I think it's good news. But it does tell you, when it comes to this kind of a hedge, what can you do? So here we have the $83 put strike price and the $86 call strike price. So we have this upward sloping trend line. Remember here, you are bullish interest rates, you're bullish the interest rate pricing. Remember, when bond prices are going up, that means that interest rates are going down. So you're bearish on interest rates, meaning they're going lower, and you're bullish on the bond pricing. But since we're basically capped out at zero, how much more is there to go? Another reason why you want to have potentially a collar trade on or some other option spread to help you weather the storm as you are buffering up against a ceiling. I mean, no matter what, we could go, I guess you could go into negative territory. I mean, we have had synthetic negative interest rates, but I really highly doubt that the Fed is going to start to pay people to actually borrow money. It's not banks to borrow money, because then that's a whole nother issue on itself. But this is a good reason why we put on these collar trades. Okay, so this gives you another way to participate in the corporate bond market without the risk. When it comes to the corporate bonds, they're like evaluating stocks. When you're looking at the indexes and the broad base market like this, you have the ability to absorb the sector. And the sector is always a good way of dealing with this instead of dealing with individual like bonds, I would say, especially now since interest rates are so low. Let me look at the questions we have. Why would you not exit at the bottom 4 days ago? Let's see, that was, why would you not exit at the bottom 4 days ago? Well, how do you know that was the bottom 4 days ago? That's the first thing. Never trying to pick a bottom or a top. The main thing is, when do you exit? You have to have your target parameters involved. So for instance, like when you have corrections, what are you looking for? And I'm actually going to get to an example really quickly, and that will probably answer as we move on that question. Let's see, another question. Should you be worried about the sell call being assigned if it goes above the call sell strike price? No, absolutely not. And remember that the reason that you're putting on this trade is you like the ETF. However, if the market rallies above the call strike price and you get exercised, that means that you're making money off of the rally. The only thing you're losing is the debit that you paid for your option. So you can always buy the ETF again. So it's like this. I always tell people, you don't want to let a winner turn into a loser. That's one of the reasons why you do strategies like this. Now, if you have an upside target price, which in this case you do, if a market rallies above your call price, you're making money. So you don't lose money by taking a profit, especially when you blow through your target. So in that case, it's, you could say, well, I am out of the market, but you can always get back in. And the thing is that if you've gotten out of the market and you made money on your trade, there's nothing to be disappointed in. It's like when you're when you're on the tee box of a par 3 and you hit the green and you still have a 25-yard or 25-foot putt. Well, how many people hit a hole-in-one on a par 3 consecutively? You know what I'm saying? So that's basically the same thing. It's like if you hit the green on the par 3, you're already there in par potential. Take your get it close, tap it in, and take your par. And be happy with being up a winner. Remember, pigs get fat and hogs get slaughtered. So you don't want to be a hog. You'd rather be a pig and eat nice and stay plump. So we'll get into the next example. I think it'll be a little bit more clear on this. So HYG, the high corporate bond ETF that we were just talking about. Look at what has happened since then. Since then, ironically, with the Fed not only buying the institutional debt market from the federal side and now saying it's going to back the corporate side, look at what's happened so far. This market, the day that we put on this first slide, was trading up near its highs. Now it has fallen below this upward sloping support line. So that's the first indication that we have a potential for a neutral to lower trade developing. It hasn't yet, because remember the high that we're coming off of and this low that was made a few sessions back here, this was a higher move low. Remember, when you have higher move highs and higher move lows, that's indicative of an uptrend. However, in the short term, this low, this higher move low, could potentially be the beginning of the new slide lower. Why? Because it took out this low back here. So we made a higher move low in the longer grand scheme of things, but we went lower than the last higher move low. And we are now no longer in this upward sloping support line here. So these are two neutral to bearish indications that there's a good chance that this market could go lower. Now remember, when you put this on, that you put this $86 call on, this $83 put, you sold the put, you bought the call for a net debit. Well, guess what? Right now, time has eroded. Remember, time doesn't really mean very much. Volatility doesn't move very much, but the market has traded lower. Now you're trading just above the strike price. So this is a situation where, and especially since we've just made this low the way we did it, if yesterday's trading, if this is the cap, if we don't get above 85.14 where the high was the day before this slide was first made, then what's going to happen here? We have the potential to take out these lows. And if we take out this 81.84 level here, you're looking for a nice corrective move lower, which means your collar trade would be good. So in this case, you're still long the high corporate bond ETF situation. You're very prepared with this collar trade right now, and you still have a month to go. And if the market does rally and all of a sudden finds a big gush of strength, well, then you get exercised on your call, you make money, and you just lose the difference of the debit. So you're still going to be positive on that scenario. Remember that when you blow through your call, you're making money no matter what. It's the downside that you're using this for, is to limit your downside exposure and limit your downside losses. So remember, if you get exercised once again on the call, it's a good thing. It's a good thing. Let's see. I did not see anywhere to select option strategy for trading. That's something you have to do with on the eOption.com website, and I believe they have a support tab for that as well. So that would be in their strategy book line. So anyhow, that's the corporate bond ETF, the HYG. Now let's look at the XLF. This is the financial selector index. So this is a way of trading the financials, the bank stocks and the brokerage houses and stuff like that, in a way that instead of dealing with the individual ones, you deal with this one. And for this trade here, back in this, we did all these ETFs on the same date, on June 8th. This is one where you would have sold the XLF $28 call for 59 cents and bought the XLF $25 put for 63 cents for a net debit of 0.04. So you're looking at next to nothing to put this spread on. Now remember, when we were talking about maximizing your profits, and definitely by doing that by cutting your bottom line, because if you cut your bottom line, no matter what, you are either making your profits stronger or you're reducing your losses. So if you can put on a spread like this was on June 8th, it expires on July, and this one goes out to July 24th. You're looking at almost 2 months for this market to move away from the point where it was at on June 8th. Now in this situation, obviously the market had been going higher. They've been making higher move highs and higher move lows over the past couple of months. But remember, you're kind of shaky, the stock market and things like that, especially financials with what's going on. That's why you put on a trade like this. And think about that. For next to no cost, remember, it costs you only 10 cents an option. So you're talking about 20 cents for the option plus the 4 cents. I mean, you're looking at nothing to put on an options hedge where you have basically a covered call or a protective put, which equals a collar trade, all for next to zero, and you have almost 2 months in which you have the ability for the market. If it just moves $3, I mean, think about the day that I did this, the market was trading at $26.54. The day before that, it was at $25. So it was $1.50 move right there. And you're looking for this market just to move. It's in the middle of a $3 range. It's not that it couldn't stay sideways for the whole time. However, with the way the volatility is going here and the way the market's trending, I think you can see where I'm getting that. This was a layup trade. I mean, this is crazy. It costs nothing, just literally dollars to put on a trade that within any time the market moves $3, $4, it's great for you, either to the upside or to the downside. Now, silver, this is another great one example we're going to run through real quickly about how you can participate in broader markets and not take the risk. Remember, I told you futures and futures options are for experienced traders, people who are capitalized, and you definitely have to have a trading plan. You have technology. There's a whole, I could spend a whole day talking about what you need to have before you're ready to do that. But if you want to participate, for instance, in the silver market, here's a great way to do it. You have the SLV, Silver Trust iShares. Now, when I put this trade on, once again, all these were done at the same time. I've looked at these prices and I'm like, okay, well, we had to the day of the trade, we had looked like we were coming off a new higher move low. So I marked the last low here at 1570 because there was a 1550 put. So I'm like, oh, this is great. We'll use that as our base because if we're looking for a protection, we wanted to capitalize off of the put as much as we can. So this was a 1550 put, and the SLV 1750 call was above our most recent higher move high. So when we did this trade, SLV, so we sold the SLV 1715 call, bought the SLV 1550 put for a net debit. Now here is what's interesting on what was going on. Why would we do that? Well, the silver had a good run up. They do it for the same reason as all the other ETFs. You're bullish the silver market or the whatever the other ETF market it is, but you don't want to get out of it, so you have to put on a position. So when I did this, interestingly enough, if you look at this gray line here, this is the date that I put on the silver position. If you go back to here, see how it is June 8th, this is the date. See how it's above that upward sloping yellow line, that support line? Well, on June 8th in the futures market, it was there the same. Now the futures market the chart looks a little bit more full. You would wonder why, but that's because there's a difference in volumes and also pricing a little bit. Remember, the cash market is one, the futures is always at a positive, it's either at a credit or a debit above that. So one thing that I noticed on this date was that we had just made this high here, made a higher move low, higher move high. But then this date here, I'm like, this is a higher move low. I'm like, okay, so this will be our baseline, $17.39. This is good. You know, this is what was going on in the silver chart back then. Well, now this is today, or actually as of yesterday, because out of rulings, you can't have live futures data. Everything has to be in delayed. So this was as of yesterday. So over the past couple days, it took out the neckline here, which is a head and shoulders here, which is a sell signal. So you got a shoulder here, a head, and a shoulder here. Then you have a bearish engulfing line sell signal. That's this big down day right here, which also ironically was the same time that it topped out here in the ETF. So on the day when I looked at the ETF thing, I'm like, okay, I looked at the silver. I'm like, okay, well, here's this, but there wasn't a head and shoulders yet. It was just a bearish engulfing line. Then I looked at it today and I'm like, oh my gosh, I haven't looked at silver since then. And it turned out to be a full-blown head and shoulders pattern, with this being the shoulder, and the past couple of days coming right down to this upward sloping support line holding up the silver market. So great time that if you're getting shaky being long the silver market, well, you have a head and shoulders sell pattern, plus you have the bearish engulfing line sell pattern. Not that these things mean that the market's going to go lower. However, if these things work, you have the market most likely heading down towards the 16 to 1550 area. You know, not necessarily bearish, but a bearish correction. And that's why you put on a trade like this. So ironically, we looked at the silver and look at where it is. Here it is, the day that we put on the trade initially. That day, the silver ended up rallying for the next couple of days, set the shoulder, and then see, this is a head and shoulders as well. Came down, did the same thing, took out these upward took out the neckline from the head and shoulders, sell signal, and then it took out this long-term upward sloping support line, and today still was below it. Remember, there's a discrepancy. Remember I said between the futures and the cash? The futures was still on that or above that line, but the cash, which is indicative of the ETF, was already below it and trading below it. So that means that the collar trade is a plus, and you have, for the same rationale, once again, being like you want to be long silver, but you're looking for a short-term correction. There's a gap to be filled here on the ETF. It wouldn't, like I said, get down to like say 1550, even down to 1450, get a nice little bounce, stabilize, and then there you go. So that's how you can trade another big broad market sector without using expensive derivatives and risky derivatives. Now we have the Russell 2000 IWM ETF as well. Here's another example where at the same time period we had the 160 call and the 150 put, which means your collar trade, you sell the IWM 160 call, you buy the IWM 150 put. You can see how this was in the same type of scenario. We marked a little last low, higher move low here as a support base and a target area. And this will be another market that has high liquidity, and it's a broad-based index that can help you participate and at a very low cost in these markets. Like I said, remember, if you trade the futures, you have to pay the commissions in and out on those things, but not on just the futures, but on the options. So you don't have to do that with ETFs. And also pricing. If you think that you're going to get as tight a spread in the futures market or even the Forex market or the futures options market, you will not get that like you will in the ETF and ETF options market. So where you may not get the full leverage capability, and you will not have the highest risk exposure, and your cost basis is also less. Remember, trading, you want to make money. Trading is a business. It is not gambling. Your whole point of investing in trading is to make money. So one thing you can always control is your costs. If you choose to pay high commissions, if you choose to pay high costs, you choose to raise your bottom line. That is a financial decision. However, if you choose to try and keep your costs down, which is a smart business decision, I think, and has been proven the test of time, then you want to cut your costs, which you can by trading ETFs for free, cut your costs by trading options for only 10 cents, and also cut your costs by having a tight spread getting in and out of these options. So here we have the S&P oil and gas market here. Now this is going to be one really good example as we wind down this webinar. So we have the $75 call and the $65 put. Look at how this market, remember how oil all of a sudden it came back off from March, exploding into June. All of a sudden we're paying higher prices. I mean, I paid $1.69 at the pump for a month and a half for unleaded, and now it's back up to $2.25. So this is where it was when I started this slide. Here's where the XOP was today. Look at this. The market tanked. So think about this. You would have sold your money. You would have made money on your $75 call, and also you bought the put. So you're up money on that. So you're still in the ETF had you exercised this trade and put this on, and you would be already up a really nice amount of money, and you still have. Look at this, July 24th. See how we made this higher move high, and we recently made this low 2 sessions back. Now we're kind of bobbling around. If this is a lower move high from yesterday, and we take out this bottom right here, that we made a couple sessions ago, that would mean that we do what? We made a high, we made a low, we made a lower move high, and then a lower move low. Very bearish, which would help to accelerate this the pricing on your collar. So remember, you got over a month to go. So time's not an issue, but pricing is. The lower it goes, the more you'll make on that hedge before it eventually bounces again. So, and now we're going to look at the EEM. Which is also a July 24th expiration heading out there. Now this is the EEM is the iShares MCI emerging markets. So if you want to participate in your emerging markets, this would be the ETF to do it in. Now here, when we did this example, we found the 42.50 and 39.50. The market was right in the middle of this $3 range. So that's why we took this one, because the pricing came off of this last little low here, and it gave us the ability that if we come through this put price, we could come down this upward sloping support line, which would keep us in a bullish trend, meaning that we still want to be long the EEM ETF, but we would be profiting off of the collar trade, especially setting this up. So why switch from July 17th to July 24th? That was because of, for that particular ETF, because of the liquidity, because you could go out that far, and the pricing, it was worth it. That's why I looked at the July 17th. And there's some where you got to realize that they don't have all the same expiration dates. That's another thing that you need to take into account. The main thing is you want to be 30 to 45 days out. That was a way of stretching the longer out option for that example. Now, I want to say thank you very much. We're going to get into some more questions real quick, but I just want to give you one little plug for me. If you want to see more videos that I do, you can check us out on YouTube at Forex Trading Unlocked. Or if you want to learn how to exercise these high probable Japanese candlestick patterns, check out the book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And oh, I see the edited probable didn't get caught there. That was corrected and then not saved properly. Oh well, so once again, for eOption, maximize your option trading potential. Use eOptions for your ETF and ETF options trading. Free option trading, free option strategy trading tools like Options Play are available on eOption.com website. The free option strategy strategy guidebook is also available at eOption.com. ETF and stock trades are commission free, just like all the major other competition out there. And eOption also has option contract commissions that are only 10 cents a contract, which is bargain below. You're not going to find a better deal out there, folks. And remember, you also get what you pay for. You want to be with someone with a history. They've been around for a long time. They've been in all kinds of markets up and down and through all kinds of geopolitical things. And as we move forward in technology, you want to be with somebody who hasn't been around for only 3 years or 3 months or whatever, because you will find that you're not going to do well when the markets really start to decay. One more thing is, apologies if it is already explained. Why do you do collar trade? You sell call at a price. What happens if the stock goes up to the stock price? Once again, if the market goes through that call price, you are making money on your ETF, and where you will get exercised on your call, and you'll just lose your debit, which will be that minus when you get out of your ETF when you sell it out there. That'll be the only difference. So you'll give up a little bit of your potential profit if it goes through your call price. But the thing is, you are making money, and you don't have to worry about when it goes to the downside. And the thing is that's the main thing, is that you want to stay long, and you're kind of shaky in terms of whether in the short run, whether you're going to see any real expected higher move highs. You're expecting the market to go sideways to lower. And that's why you put that on, because then when you do have a break, especially when we have right now where volatility is high. So where volatility doesn't affect your pricing for your trade, that's why I used the collar example. When volatility is high, like the VIX is high, this is a great reason to put those trades on, because odds are the market's going to move. And if you notice, most of those were only $3 wide, and those markets were trending in $5 moves. So the potential for you in that time frame to move $1.50 to $3 in either direction is high. So if it goes to the upside, you're making money. You're just not making as much. And if it goes to the downside, you're still long your ETF, and you can still make, and you're going to make a nice little bit of money on the side as well. So with that, we have questions about the ETFs and options. I think we're right at the time limit, and we don't have any more questions. So
Eddie, there were a few questions in the chat room I just wanted to throw out to you. Someone asked, is the data you use real time? Is there a delay, such as 20 minutes for bets?
Okay, for the data that I use for the webinar, obviously this is everything. This webinar is obviously in delay. Everything was already, made up before. But the data that I used, the pricing from the options, that was all live pricing from the SIBO. And then I also used the futures, obviously was delayed for the silver example, but for the ETFs, that was just a 15-minute delay on that. So, but I used the opening prices for today's numbers to see the differences because I started on June 8th was the original slides, and for those examples to see how the pricing and the markets moved to show how they would have reacted. That's why I used those.
Okay, great. No, thank you for the explanation. And we just got one more question. Sure. That someone had just missed part of the webinar. And yes, this is recorded, and we will post it to our website in a couple of days. So if you go to eoption.com, under resources, we have a webinars and videos tab. So you can click there. It will be there in a couple of days. We will also email it out to each person who attended this webinar in a couple of days, so you can review it at your leisure. And just to wrap it up, Teddy, thank you so much for an interesting and informative webinar. And hopefully,
you're welcome.
Everyone who attended, actually, we got a few more questions in, so
okay.
Maybe we'll just try to address those.
You want me to? I saw one here. Would the concept still work for stocks versus ETFs, or is it more favorable for? No, absolutely, it works for stocks, especially right now with the volatility. I mean, you look at a stock like, for instance, Tesla. You're long Tesla stock. You put on one of these positions. Now, I would suggest probably straddles or strangles more for a stock like Tesla, because, I mean, every time Elon Musk says something on a video chat somewhere or something, the stock moves $10, right? So that would probably be more of what I would suggest. But also with Tesla, especially with the market, if we get a big sell-off in the Nasdaq and things like that, Tesla is still going to probably take a hit for a little bit. So a collar would be a good example for a market like that, for a stock as well. But it depends. For other stocks, I would say more of your bank stocks right now, your brokerage stocks, or you're probably even like your more tried and true stocks like Walgreens, Johnson & Johnson, the ones that will maybe have an initial sell-off should we have another second wave from the coronavirus and the market gets hit, because those will bounce back quick. So those are ones you probably want to hold. So the collar example would be good on that, because if it breaks, you're going to be hedged. You're going to have a little bit of juice while you're getting dividends too, and then you are obviously either readjust different option strategies once you've had a correction, so that's a totally different story, and it's also about what your objectives are. Like I mentioned, when I did these examples, it's under the premise that you're looking to hold these ETFs. Okay. You want to stay long these markets, but you are at least short-term neutral to bearish. But if the market rallies, you're willing to forego a little bit of profit because you don't want to lose what you've already gained for the most part, So, I mean, if you're only giving up a couple percent of what you've already gained and also have the potential to even increase your potential reward, then why wouldn't you do it? So that's why you put these strategies on. So they do work in the stocks, to answer that question.
Okay, great. And then there was one more question. When you say long, do you mean owning the ETF?
Yes, that means you own the ETF for sure. So if you were shorting ETFs, it's a totally different topic. But this is what all these were under the premise that you want to participate in these broad-based market sectors. And while you've been long them, you've already been in a position, instead of just having a corrective stop in the market, which is one thing you would do. If you didn't have, for instance, if you didn't have a collar on or anything like this is something I have to say to all you viewers out there who catch this webinar. If you don't have a stop in your positions, you should. You definitely should. So, but that's why you use option strategies, so that you can take off the stop, don't worry about getting stopped out in the market, and take advantage of market swings. So it's a way of using the mechanism. Remember, there's all kinds of market mechanisms out there. Most people just choose not to use them. That's their choice.
Okay, great. Well, thank you so much, Teddy. We're going to wrap
You're
it up
welcome.
now. And thank you to everyone for attending this webinar and for taking the time out of your busy day. We really appreciate it. There were a few questions about entering option trades on our mobile app, as well as our trading platform, how you can easily enter spread trades. And so I would encourage you to give our trade desk a call and they can walk you through it. And you can either email them, or the phone number is 888-793-5333. Again, 888-793-5333. And that will give you an experienced trading professional who would be happy to walk you through it, how to do it. And so again, thank you. And we'll be having more webinars on option strategies in the future, and we'll send you details. You're on our list now. So we'll let you know, give you advance notice of that. And you can also go to our website at eoption.com under resources, and you'll see the webinar tab there. Like I said, you'll get the video recording later this week of this webinar, and you can also see our past webinars, and we also have other instructional videos on there. And we also have a lot on option strategies. So if you go to our website and you click on strategies, you can hit the collar button. It'll walk you through exactly how a collar works, how to enter it, the advantages, and so forth. So we do have a lot of great education on our website. So please feel free to check it out at eoption.com. So again, thank you everyone for attending. We greatly appreciate it. And we hope to see you at our next webinar in the near future. Thank you.